Good morning, everyone, and welcome to the Daily Hunt for Multi-Baggers, your daily dose of market commentary, airing bright and early on Tuesday, November 25th, 2025. We've got a fantastic episode lined up for you, breaking down some really interesting insights from Monday's market chatter.
That's right, Ethan. Yesterday, our AI scoured through a significant volume of social media discussions, flagging a diverse range of stocks. The overall market sentiment, it felt pretty mixed, leaning a bit promising for some of the tech giants, but certainly with some clear warning signs for others. Lots of volatility out there, as always.
Absolutely. Let's jump right into it. First up, we've got Microsoft, MSFT. Our AI-generated insights are pretty bullish here, seeing it as a rock-solid, dependable long-term investment. Users are highlighting its AI leadership, strong revenue growth at nearly 18.4%, and that incredible 35.71% net profit margin. We've consistently rated Microsoft as a buy or cautious buy, and today that buy rating holds strong.
Well, Ethan, while those numbers are undeniably strong, Microsoft's PE ratio is sitting at 33.66, suggesting those growth expectations are pretty much priced in. And let's not forget the recent news of MSFT being down more than 12% since Q1 2026. Even for a Magnificent Seven company, that signals some short-term headwinds. We also had an anomalous debt-to-equity figure that needs a closer look. However, given its overall stability and market position, I'd say we reaffirm our buy classification for MSFT today, but with eyes wide open on that valuation.
Fair point, Brooke. Next, we're looking at Pagaya Technologies, PGY. This is an interesting one, a new contender for our discussion. The user sentiment is bullish, pointing to an earnings beat, a higher outlook, and robust quarter-over-quarter growth. We're talking 36.1% revenue growth, and get this, a return to net income at $23 million this past quarter. Analysts are even giving price targets as high as $40.
Now, hang on, Ethan. While that quarter was certainly positive, the trailing 12-month figures tell a different story for PGY, showing negative net profit margins and EPS. And let's talk risk, an extremely high debt-to-equity ratio of 141.786 and a beta of 5.858. That's highly volatile. For a fintech company, that kind of leverage combined with inconsistent profitability should be approached with caution. Given it's new to our radar, I'd lean towards a cautious buy for PGY. There's potential, but significant risk.
Caution is always key, Brooke. Moving on to Nebius Group, NBIS. Unfortunately, the main social media post here shares a user's significant losses after investing. While there's some mixed news about major contract wins and a Nebius token factory for AI...
Ethan, the KPIs for NBIS are screaming stay away. We're seeing negative earnings per share, a deeply negative operating margin, and a high debt-to-equity ratio of 94.974. Even Jim Cramer has called Nebius too speculative. Despite the glimmer of positive news, the fundamentals are not there. We previously rated NBIS as a speculative gamble, but given these current red flags, I think it's a clear stay away for NBIS today.
Got it. And speaking of clear decisions, First Commonwealth Financial, FCF. The data on this one was a bit, misaligned with the user discussions, which were actually about Meta. But looking solely at the KPIs for FCF, we see a missing free cash flow figure, a very low return on assets at just 1.18%, and revenue growth that, while positive at 12.8, isn't exactly groundbreaking.
Exactly. With no free cash flow data, it's hard to get a real read on its cash generation, which is crucial. Plus, that low return on assets means they're not efficiently using their resources to generate earnings. We previously flagged FCF as a stay away, and based on these generic KPIs, I'm afraid that remains a stay away today.
Next up, Corsair Gaming, CRSR. The initial post was quite bullish, touting insider buying and a margin glitch that could lead to explosive profits. There's also news of a Call of Duty partnership and a forecasted 96% earnings growth.
Oh, Ethan, this is a prime example of where user comments truly debunk the initial hype. The overwhelming consensus is that CSR is a reseller, not a manufacturer, so rising DRM prices hurt them. They're sitting on negative net profit margins, negative EPS, and an exceptionally high debt-to-equity ratio of 30.504. Plus, the stock is near its 52-week low. Despite the optimistic post, the community and fundamentals suggest a stay away for CSR.
All right, let's turn to a behemoth, Alphabet, GOOG. We had a lot of discussion here, and the overall sentiment is strongly bullish. Users are celebrating significant gains, praising GOOG as a quality long-term compounder. The Gemini 3 AI rollout, that NATO Google Cloud contract, and stellar KPIs like a 32.23% net profit margin and 15.9% revenue growth really underscore its fundamental strength.
Now, for the most part, I agree with the bullish sentiment on GOG's core business. However, there was one post highlighting significant gains from GoGo Leaps, and the comments were very cautious, with users saying things like, "We've all seen how this story ends." It's currently trading near its 52-week high with a PE of over 31. While the underlying business is strong, that valuation means a lot of future growth is priced in. But for such a dominant player with constant innovation, especially in AI, we'll reaffirm our buy for GOG. Investors should, just be aware of the valuation.
Agreed. Let's discuss NVIDIA, NVDA. Our data for NVDA was pretty mixed today. One analysis was very bullish, highlighting record sales and a Bank of America forecast of $40 EPS in 5 years. But then we had another post, "What the hell is going on with NVDA?"
And that's where the red flags pop up, Ethan. User comments highlighted that the God-tier earnings were already priced in, leading to a sell the news event. More critically, increasing competition from Google's TPUs and Meta considering alternatives directly threaten NVIDIA's market dominance and future margins. Its PE is still a high 45.30, and it carries a very high debt-to-equity ratio of 8.815. We upgraded NVDA to cautious buy recently, but the competitive threats and high valuation mean we're downgrading it to stay away for now.
A sharp turn there, Brooke. Next, Applied Digital, APLD. Despite a user lamenting buying a dip that kept dipping, there's still a noticeable long-term bullish undercurrent in the community. Users believe APLD will bounce back, citing new data centers coming online and talks with hyperscalers. Plus, that revenue growth is strong at 84.3%.
While the optimism is there, Ethan, the fundamentals for APLD remain deeply concerning. We're looking at a company that's currently unprofitable with negative net profit margins and EPS. And talk about risk, an extremely high debt-to-equity ratio of 63.196 and a jaw-dropping beta of 7.061. That screams extreme volatility and financial risk. We've often rated APLD as a stay away or speculative gamble, and today, for most investors, it remains a stay away.
All right, let's talk Apple, AAPL. Our analysis points to a bullish future for Apple, particularly in spatial computing with the Vision Pro. Users see them as a market leader, setting trends in VR, and there's news of strong iPhone sales. It's currently trading very close to its 52-week high. But Ethan, that's precisely the concern. It's trading at a PE of 37.036, which is incredibly high for a company with only 7.9% revenue growth. While the Vision Pro is exciting, that kind of valuation already bakes in immense future success that is, frankly, still speculative. Its debt to equity is also quite high. We previously rated AAPL as a stay away, and until we see clearer evidence of how Vision Pro will significantly impact that colossal market cap and revenue, it remains a stay away for us today.
Finally, Amazon, AMZN. The main post showed a user with 126% Roth IRA gains, driven by AMZN Leaps, indicating strong belief in its future. Amazon is making massive investments in AI and data centers, launching new services like Project Cooper, and analysts are reaffirming buy ratings.
Ethan, I'm cautiously optimistic. Amazon's strategic investments are indeed impressive, and its 13.4% revenue growth and 11% net profit margin are solid. However, that PE ratio of almost 32 means those expectations are high. Also, the stock saw a significant spike after its recent earnings, but then retreated, showing some short-term volatility. We last had AMZN as a speculative gamble, but with these strong initiatives, I think an upgrade to a cautious buy is warranted. It's a long-term play, not a quick win.
Great summary, Brooke. What a dynamic day in the market.
All right, let's quickly round up today's picks for a deeper dive. Investigate as buy. Microsoft, MSFT. Alphabet Inc., GOOG. Broadcom Inc., AVG. Meta Platforms, META. Investigate as cautious buy. Pagaya Technologies Limited, PGY. Amazon.com, AMZN. Investigate as speculative gamble. Apple Inc., AAPL.
And that wraps up another episode of The Daily Hunt for Multi-Baggers.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in.
We'll catch you all tomorrow for more insights. Happy hunting!